For about 4 days in June 2026, Elon Musk's tracked net worth crossed $1,300 billion, roughly $1.3 trillion. That figure represented a larger share of the total U.S. economy than John D. Rockefeller held when he became America's first dollar billionaire. Within a single week, roughly $240 billion of that wealth evaporated. Musk lost that fortune without paying a cent in taxes or spending a dollar. The capital disappeared on a live ticker while he was legally unable to sell a single share. Both the trillion-dollar peak and the following crash are defined by a single fact. None of it was ever actual, spendable money. The math behind the peak traces back to June 12, 2026, when SpaceX went public. The company priced its shares at $135 each, raising a record $75 billion in its initial offering. Musk personally owns roughly 5 billion shares of the company. Before the listing, the value of that stake was based on infrequent, private estimates. The moment the opening bell rang, those internal guesses were replaced by a live, second-by-second market price. Right in the middle of this initial surge, a second massive variable landed. Musk exercised options from his reinstated 2018 pay package, immediately adding more than 300 million Tesla shares to his tracked wealth. While the valuation soared, only 4 to 5% of the total SpaceX shares were legally available to trade. The vast majority of the stock remained locked up under standard post-listing rules. Massive investor demand squeezed into that tiny available supply. This buying pressure bid the stock up 67% in just 4 days, pushing SpaceX's total valuation near $2.8 trillion. Extreme spikes in billionaire wealth are frequently driven by this kind of constrained share supply, rather than an increase in a company's fundamental production. That thin market soon encountered 3 specific financial realities. First, SpaceX announced a $60 billion all-stock acquisition of the coding startup Cursor, which immediately diluted the equity of the new investors. Days later, the company moved to issue $20 billion in corporate bonds. The sudden need to borrow so much capital raised immediate questions about how SpaceX was managing its record-breaking cash reserves. The recently merged xAI division was burning through capital, posting a $6 billion operating loss on nearly $13 billion in spending during the previous year. Those financial pressures coincided with the opening of options trading on June 17th. For the first time, short sellers had a mechanical tool to place large bets against the inflated stock price. The selling pressure overwhelmed the limited float. The stock fell 16.4% in a single session, a one-day loss of $400 billion in market cap that crushed Musk's tracked net worth. When a stock price relies on artificial scarcity, standard corporate friction is enough to trigger a devastating mathematical collapse. Musk did not buy or sell a single share of SpaceX during this boom and bust cycle. Standard post-IPO lockup rules mean his personal shares are legally frozen. He cannot sell them until June 2027 at the earliest. The brief appearance of a trillion-dollar milestone reignited arguments for taxing extreme wealth, with figures like Senator Elizabeth Warren pointing to the surge as proof that the current system requires reform. Others note the impracticality of that proposal, pointing out that redistributing this entire paper fortune across every household in America would result in a one-time payout of roughly $1,500 per family. At this scale, net worth functions as a volatile, live price feed on locked assets. It is a number capable of swinging by more money than most countries make in a year, before anyone involved has legally sold a single share. To follow where the actual liquid capital moves next in the market, subscribe. This number is nowhere near done moving.